Oil markets are sending a message. Even geopolitical risk may no longer be bullish. This is Sectors Up Close, and today we're talking about oil. Oil prices are headed for their worst year since the pandemic, and Wall Street believes the selling isn't over. Brent crude is forecast to slide to around $59 a barrel in 2026, as according to the average of 5 banks. But geopolitics refuses to stay quiet. There are ongoing efforts to end the war in Ukraine, while tensions are rising in Venezuela. The oversupply signals are unmissable, but how much geopolitical risk will it take to shake the bears? Let's ask Homayoun Falakshahi, senior oil analyst from Kpler. The US is tightening its grip on its oil exports. If that escalates, even to the point of a direct US strike, would markets absorb that shock?
It is obviously a significant actor, but even if you assume that their exports crash, which we don't think is going to happen, but even if in that scenario, I think the market is supplied enough so that to absorb the shock. And therefore, I think even in the most extreme scenario, we wouldn't see prices reacting too aggressively to the upside.
Well, let's talk about a potential regime change in Venezuela. Could it eventually revive its oil infrastructure and unlock more supply? And does that prospect strengthen the bearish outlook for oil?
Longer term, we do think that the potential, obviously, from Venezuela is huge. It's still the country with the largest oil reserves globally. In front of Saudi Arabia. We do think that over a matter of 12 months, assuming regime change and sanctions been lifted and, Western companies back in the country starting investing massively, over 1 year, we do think that the upside is something around 200 to 300 KBD, 1,000 barrels per day of oil. But obviously longer term, let's say in 4 or 5 years later, the upside would probably be closer to a bit more than 1 million barrels per day. So the potential obviously over there is huge, and over the longer term, it could actually support or actually offset some of the production losses that we're going to see elsewhere.
Let's talk about oversupply. It has become the dominant oil narrative. Citigroup argues that continued stock buying by China will cushion the market. Is the glut story overdone for next year?
If you look at China, they are building a lot of new storage capacity. And just for the sake of, launching these new facilities, they would need to, at least to an extent, start filling those new tanks. And so just for operational reasons, that means that Chinese storage, onshore storage, could build by a minimum of about 90 million barrels next year. And that's quite similar to the levels we've seen so far this year. In total, the build has been a bit over 100 million barrels. But so on top of that operational, I would say, build, we could see more oil going into the strategic petroleum reserves, on top of just refineries scooping more barrels because they believe that the market is quite affordable. So yes, that is going to be one of the key stories to watch, to try and assess where oil prices are headed, because obviously it's a huge support to prices.
Well, JP Morgan says that the surplus actually looks bigger than reality, as OPEC Plus is likely to reverse course and slash production. Do you see that as likely for the cartel?
We still believe that they will actually go ahead and continue unwind, especially before the summer month when demand peaks globally. But if we are in a situation where storage builds massively, then there could be potential to pause further or even to unwind more. So everything is possible, but so far we do believe that they will continue unwinding.
As well, a potential peace deal between Ukraine and Russia remains a major wild card. Goldman Sachs says a deal could knock $5 a barrel off prices. Is that realistic?
We do believe that it doesn't mean much, at least in terms of crude market volumes, because Russia has been exporting quite a lot of oil. Where it will matter is, we'll see less attacks from Ukrainian drones on Russian infrastructure, and so more exports of clean products such as diesel, and that would mean probably lower margins for the refining sector. So I would say that $5 per barrel makes good sense.
Finally, Homayoun, let's look at the forecasts. They're all over the map for next year. Where do you see the true floor for oil prices in 2026?
We think the downside actually is quite limited from here, and even though we may see spikes to the downside in the next 2-3 months, we do think that at some point next year, oil prices are going to reverse course and reverse that long-term declining trend that we've had over the past 2-3 years. And that's because we think that at some point in the middle of Q2 next year, the market is going to shift its focus towards what's happening in terms of production later on, and probably later in 2026 and 2027. And beyond Guyana, there's not much production growth coming from non-OPEC plus countries, and spare capacity within OPEC plus has been dwindling because of the group, increasing production over the past few months. And so because of that relatively small spare capacity, we think it will be around 3 million barrels per day in the middle of next year. The market will have reasons to actually become a bit more bullish. So the average that we have for Brent is around 60, between 64 and 65 for next year.
That was Homayoun Falakshahi from Kpler. Don't forget, you can watch more videos on Reuters.com.